Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, we are going to get into the top 3 year-end financial planning strategies that you need to understand. But before we do that, as always, I gotta give you the free tip of the week, and I'm gonna read it verbatim. If you don't understand why you own what you own, look to get rid of it immediately. Now, this actually doesn't just pertain to investments. It actually pertains to everything. It's kind of like a year-end cleaning. I'm not really like a garage sale type of guy. But it's kind of nice toward the end of the year to even look through your closet, look through your living room, your wardrobe, whatever the case is, and go, do I really need this anymore? And if you don't, maybe you can get rid of it. I mean, we live in this world of absolute abundance, and we're all about abundance, especially listeners in the United States. But is abundance the right way to think about living a successful life? I don't know. I mean, what do you think? And in fact, I want to know what you think. And if you want to DM me on Instagram, or if you want to shoot me an email and let me know your thoughts, we can actually have a conversation about it. I actually think that'd be kind of fun because we're getting a lot of messages like that. And I just like hearing what everyone's take is. So with that, free advice out of the way, we're going to get into the top 3 year-end financial planning strategies. And these are my top 3 that I would recommend to you. I tried limiting it to my big 3. When I first was thinking about this episode, I got down to about 12, and I'm like, that's a big one. So if you stick to these 3, not only are you setting yourself up for the rest of the year, you're actually setting yourself up for an amazing, we're recording this in 2024, so 2025. So the first one we're going to get into, if you run a business and are looking for a tax strategy, get a 401k open for you and your employees like immediately. And if you're doing really, really well, okay, you could even open up a cash balance plan, which is on top of a 401k. If you work for a company and that company has a 401k or 403b or a 457b or just retirement plan in general, but those are the main 3 out there, make sure you are contributing at least the match that your employer is giving you. But if you can put in more, increase your contribution. And lastly, if you don't have a 401k through your company, you will want to open either an IRA for a tax deduction or a Roth IRA for tax-free contributions to your retirement. Now, I know there's a lot there, so I want to explain some things around all that. So first, let's go over deadlines. So for your 401k, you have until December 31st to contribute to your 401k or 403b if you work at a nonprofit, or 457b if you work at a government institution. As far as IRAs or Roth IRAs for the year 2023, you actually have until April 15th not 2023, this being recorded in 2024. IRA or Roth IRA 2024 contribution, you actually have until April 15th of 2025 to make that contribution, okay? What I like to coach clients on, though, is treat it all in the same year, because then you don't get confused with this overlapping and having to track anything. And even if you have a qualified advisor or planner, generally speaking, it can be kind of a pain for them to do that too. And, then they'll probably tell you, no, it's not a pain for us. Like, we do it absolutely seamlessly. It's still a pain. Administrative duties are a pain. Okay. Now, if you run a business, your match and or profit sharing contribution to your company's retirement plan, that contribution actually doesn't have to be put into the retirement plan for the year 2024 until extensions of the following year. So in this case, October of 2025. Now, I'm not telling you wait till the last second, because then every single person that you work with will hate you. But what I'm telling you is you've got that amount of time. Now, regarding the match to the retirement plan, why it actually pains me why so many people overlook this. A match, it's free money. And, it's really not the best idea to miss out on free wins in life, because you don't get many opportunities with that. And it doesn't matter what the match is. I mean, the most common that you hear are, let's say 50% up to 5% of your contribution, or dollar for dollar up to 4%, or 50 cents on the dollar up to 3%, whatever it is. I don't really care what it is. What I care about is whatever that to 3% or 4%, whatever that percent is, you want to make sure you put in at least that much into your company retirement plan, because they're giving you free money on that. So if it's 50%, they're giving you a 50% return on your money. If it's dollar for dollar, that's 100% contribution. That's fantastic. Okay. Now, if you work at a company 401k and you have a Roth contribution ability, and let's say that you're in a lower tax bracket, and Roth is after tax. Okay. So you put the money in after your taxes, and then it grows tax-free. With traditional retirement plans, like just normal 401k, if you want to call it that, you put the money in before you pay the tax, it grows tax deferred. And then in retirement, when you pull the money out, then you're paying ordinary income tax. Okay. No different than your W-2 wage today. But back to the Roth side of things. So if you have a 401k in your Roth, it's Roth 401k eligible, and you're in a tax bracket, like a lower tax bracket, I would say anything below 12%, okay, blended tax bracket, I would contribute Roth. And there's a number of reasons for that. If you don't have a 401k and you're in a higher tax bracket, you're going to want to contribute to the IRA to get a tax deduction. Now, if you don't have a 401k and you're in the lower tax bracket, it's the same thing, but it's the Roth IRA, not Roth 401k. That's going to be your best bet. You can technically like mix and match if you want to get really creative, but frankly, I think that's a little too extreme for all in one episode, and I want to make it just really easy for you to get this ball rolling. And we've also talked about this in the past. As far as how to invest these, if you have a 401k through your company, I can't give specific investment advice. One, I don't know all of your guys' investments to a T. And then two, not only like compliance aside, I just think it's very imprudent to give just very blanket investment advice. Like everyone just needs to buy this fund. I think that's absolutely silly and ridiculous. But what I will tell you is target date funds or life cycle funds. Those are not what they seem. And I explained this on a recent episode of one of my pet peeves of finance. I cannot stand how inappropriately sold target date funds and life cycle funds are in our industry. Okay. And frankly, I'm just going to have you go back and listen to my financial pet peeves episode, because I tell you ad nauseum why they can be so detrimental to you. So you're going to want to meet with a professional, and your company generally should have like some type of advisor or planner or investment guide attached to the 401k, and you can call them and they can help guide your investment portfolio for you. But I'm telling you right now, if you've got a long-term time horizon, and by long-term, I'm talking at least a decade plus, your 401k should be invested in as much stock market as possible. It should be as market focused as possible. Now, if you're within 10 years, or for sure, within 3 to 5 years of retirement, you're going to want to meet with a quality certified financial planner. I wouldn't really go the advisor route. I think they're becoming outdated. I've talked about that a lot in the past. A quality certified financial planner And you're going to want to get your retirement all squared away, assuming you've saved enough. Okay. Now, the reason why that's really valuable is once you've got all that squared away, imagine being able to retire on your terms, not your money's terms. That's huge. And you may not think that's a big deal now, but what if you go and you meet with someone and you get everything squared away and then there's a correction, like 2022 when the market was down 20%. Suddenly, a lot of people could not retire. And in fact, even though we're recording this in 2024, some people that were about to retire at the end of 2022, but then they realized because they were invested in prudently, they couldn't. They're still working to claw back to get to that balance that they needed to actually retire. That set you back a couple years, and that's a minimum. In 2022 was by no means something like 2008 where the market was down 50%. Okay, 20 still hurts. 50 hurts a lot more. So if you're able to align your investments so you could retire even with that, holy smokes, you've got one hell of a planner on your hands, which is great. Now, I'm going to tell you if you go the IRA or Roth route, because at that route, you don't have the company 401k advisor to guide you on that unless you hire them personally, but it's neither here nor there. If you go the IRA or Roth IRA route and you have a long-term horizon, regardless if it's a mutual fund, if it's an exchange-traded fund or like an index fund or a stock portfolio, it does not, in the grand scheme of things, it does not matter which strategy is most optimal. It's what's most optimal for you. But the point is, you're going to want to look at some variation of investing in something stock market related for a very long period of time. I mentioned this a couple episodes back, and I got to give him another shout out. Nick Murray, one of my favorite financial authors in the industry, Simple Wealth, Inevitable Wealth. If you've not read it, highly recommend you get it. It just had its 25th anniversary. I read it and it was absolutely fantastic. He agrees with me on this. As long as you just get started and you do the thing, that is 90% of your success rate. Maybe 10% will actually become valuable as far as like investing in the right stock or mutual fund or index fund, whatever the case may be. But the best thing you need to do is just start. So with all of that, I know I went through a lot, which is why we're taking an earlier commercial break. But I would actually recommend listening to this over one more time because we went over a lot and I just ripped the Band-Aid off one after another. There was a lot of valuable content and I don't want you to miss any of it. So go listen to this one more time, or if not, just stick around, enjoy the commercial, and I will see you back very shortly.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. We're going to wrap this guy up with two of my top 3 year-end financial planning strategies. And the second one we're going to talk about, it's an interesting one. If you have an investment account that is a non-retirement account, look to mitigate taxes with losses to offset any gains that you may have with a little asterisk. So I first want to talk about why that's valuable. So there's 2 types of gains in the eyes of the IRS. There are short-term capital gains and there's long-term capital gains. A short-term capital gain is a gain where you've bought an investment and then you sell it within a year. When you have a short-term capital gain, you're taxed at ordinary income, which is a higher income tax. If you have a long-term capital gain, it's a year or longer, and that is taxed at capital gains rate, which is a lower tax rate. And just a fun little fact on that, the reason why is from a policy standpoint, like public policy and financial policy. The government wants you, they incentivize you to invest in these businesses longer. So, capitalism can actually like play its course. Okay. So that's a fun little bonus fact for you. Now, regarding the short-term and long-term capital gains, a short-term and long-term, they don't commingle. Okay. You can't offset a short-term capital gain with a long-term capital loss. They've got to be the same flavor here. And with retirement accounts, it does not apply. So if you have an IRA or a Roth IRA, the government gives no craps about if you're buying or selling or trading within those accounts. All they care about is if you have an IRA and you take your money out, assuming you're retired, you are taxed at ordinary income. And if you have a Roth IRA, it's tax-free and the government doesn't care. Fantastic. So one of the things that I want to talk about is something called the wash sale rule. And I know compliance doesn't really like this. I'm not going to get too into the weeds, but it's very, very valuable for you to understand. So the wash sale rule works like this. Let's say that you have a stock or an investment and you believe in the investment, but it hasn't done that well. So you sell the stock at a loss. You have to wait for 30 days until you buy the stock back. And then what happens after 30 days is the loss is washed, if you want to think of that. So you actually get to take the loss. And then when you buy it back, you don't owe any taxes, okay, on that. So you can use that loss to offset some gains that you've had within the year. Now, what happens if you buy that stock or investment back within that 30 days? Not only does that loss not count as a loss, it counts as ordinary income. So not only did you lose money temporarily on those investments, hopefully, you're paying taxes, ordinary income on that loss. That is a great way to be tax efficiently shafted, and that is not great. So if you use the wash sale rule, you've got to be very particular in using it. And you've got to be very careful because if you buy it 29 days after, the government's not going to care. Oh, I forgot. They're not going to care. They're going to go, oh, well, that's nice. Pay up. And another thing is, you've got to be really careful with the wash sale rule. So let's say you've got that company, it's down, and you sell it, and within that 30 days, the stock starts just roaring back. Well, you just kind of missed it there. Okay. I also want to caution you guys with the tax side of things. And this kind of spirals in from the wash sale rule. And this is really just from a pure, like your portfolio strategy. Most advisors stress to the high heavens the locking in losses to offset gains strategy toward the end of the year, which is actually why December is actually known as a very volatile investment month. That doesn't mean that there's any advice to invest or not invest in December. It's just like statistically, one of the 12 months has to be really crazy. And a lot of people like to do it because they're doing all of this stuff. And I want to caution you because even though, yes, it's important to mitigate taxes and mitigate those losses to offset gains, that is really a penny wise, pound foolish type of gain. And I'll use a couple examples here. So let's say you've got a company and it's just got a really good gain. Okay. Let's say that the gain, you've held it for 3 years and it's up 40% annualized over that period of time. I'm making this up. And you're like, the odds of this happening again are very, very slim. Let's just cut all of our gains and kind of move on, do something else. And you pay the tax. Well, even after you pay the tax and your investment was up 40%, net of tax, you're not going to earn 40, but who cares? You're in the mid to high 30s. That's great. I would love to earn a return like that for clients year over year. Okay. And I tell you this too, and especially with real estate. So we see this all the time with real estate where people go, oh my gosh, I have this property and I sold it and I want to avoid the tax. I want a 1031 exchange. And this investment said it's 1031 exchange eligible. Well, with the 1031 exchange, what happens is you have 45 days to locate a like asset. So if you had a single family rental and you find another, you can take the gain, you put it into the new asset and you avoid that taxable gain, but it's just deferred basically until you sell that asset and realize it. The reason why I bring that up is there are so many properties out there that say they're 1031 eligible. Yeah, they'll take your money. You'll avoid the tax, but what if it's just a crappy property and you shouldn't have invested it in the first place? So like I tell people all the time, and I know I'm bouncing around a little bit, but this is all interconnected. Taxes are very, very important to mitigate. In fact, I could argue the greatest investment that you can guarantee on yourself is the taxes you avoid, not an investment itself. However, when it comes to an actual investment that you're looking at, you got to first ask yourself, okay, if all of these tax benefits weren't at my fingertips, would I even consider this investment? And if you're just investing in something or making a move because of the taxes, that will be a long-term detriment to your net worth. And sometimes it's okay to just pay the friggin' tax. Now, the last year-end financial planning strategy, and this is one of my favorites, is create your New Year game plan to better yourself financially. So we all know the New Year's resolution craze. You make these New Year resolutions, January 1 comes around, you're motivated for 24 hours, and then by January 3rd, everyone's forgotten about it. Now, I'll tell you, there's a couple things. First off, I'm a huge believer in doing my own New Year's resolutions. In fact, December 30th of every year, I go to an undisclosed location just for a couple hours and I reflect on the year. And I actually make resolutions for myself personally, professionally, and then regarding my health. Because with my Crohn's disease, that's always been a big part of my life and I'm trying to be better with that, okay? And so, for you, it's interesting, purely on the financial side of things, not only can you write out what you want to accomplish next year, you can also retweak it as the year goes on. And you could do it daily between now and the end of next year. Like every Sunday at 8:30 a.m., I have a 5-minute reminder to go into my office and look at my goals and say, hey, am I meeting them? I'll tell you what, there's nothing more valuable than crossing those suckers off when you hit them. And I used to get really anal about, hey, well, now I got to get another and another and another and another. Now I'm at a point where it's like, hey, if you've done it, great. Like you've got all these other goals. Actually appreciate what you've done. That's something I need to work on, is just being more appreciative of like actual moments. And, for you, I think the best way to go about it is think of a couple quantifiable goals, okay? Like qualifiably, yeah, if a New Year's resolution goal is, hey, I want to get better with debt, that doesn't mean anything, right? Like it means something, but like, how do you measure that? You can't really measure it. And I think the first couple of years that you do this, you need to have measurable, actionable items that you can achieve. So a couple that I've thought of is, like for you, is build up 3 months of an emergency fund, make $100,000 a year, research 4 investments and add them to your portfolio, pay off your bad debts, max out your 401k. I mean, the list can go on and on, but these are just some examples. In my thing is, I would pick 3 financial goals and I would give one, I would say one should be really easy, not too easy, but like easy. One should be of moderate difficulty, and then another one should really push you, okay? It should really take you to the next level, whatever that means. And so by the time you get through the following year and you've accomplished these, you can do the same thing for the next year, and the next year, and the next year. And before you know it, in 5 years, think about this, in 5 years, you are 15 financial goals better than you are today. And imagine how valuable that's going to be, both literally from your bank account, as well as personally and emotionally and just your overall health. Because I'll tell you what, when you have less financial stress, you're going to get healthier. Okay. A lot less stress in your mind, in your body. And so I'm not making any guarantees, but in 5 years with 15 financial New Year's resolution goals that you have succeeded upon, I can almost guarantee your net worth will reflect it in a massive way. So that does it for today's episode on the top 3 year-end financial planning strategies. I hope you enjoyed it. I know I did, especially that last one. Make yourself some goals, stick to it. Once a week, give yourself 5 minutes, reevaluate it. And I'll tell you what, in a year, DM me and let me know how you did. So until next week, as always, keep capitalizing. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris@capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. There is no guarantee that any investment strategy will meet its stated objectives. All investments involve risk, including potential loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Before investing, carefully consider target date, exchange-traded, or index funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The people and company mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances. Any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.